Hey everyone, Doug Smaldino. Happy Thursday. Hope you're doing well. Want to reach out to everyone today and talk about what's going on in the market. I had a great video last week. Everyone really I appreciate all the compliments that we got. It's really trying to keep everyone informed what's going on. We have a big meeting next week with the Federal Reserve meeting on Tuesday and Wednesday next week. So that's going to be exciting. But today was a great day. So I thought I would just shoot out a quick video here. And then, of course, we'll recap it next week and you'll hear from us when the Fed meets. Not too worried about the Fed, but look, the thing is, all you hear right now is doom and gloom. I just put in 2022 housing and look what comes up. It's everything canceled. It's over. The end. The world's gonna blow. We're all turning into pumpkins. Blah blah blah. Buyers are broke. The collapse has begun. It's over. Hear this guy. I like this guy. Look, the thing is, these are the same guys that said it was all over during when COVID was going on. Now they're resurfaced, trying to rebrand themselves. So they had one bite at the apple, that failed. They get another bite at the apple with inflation. Think that's going to do it. I don't know what they're trying to get out of this. Maybe they're speculators. Who knows? But anyway, guess what? I've had it with these guys. I'm sick and tired of these guys. I'm sick and tired of the doom and gloom. I'm sick and tired of buyers being on the fence and worried and afraid. Okay, now I'm going to show you some good stuff now. Let's bring it in. Let's talk about it here. Okay, look, we got good stuff happening. I know people are a little nervous. You look at 401k, it's down a little bit. Mortgage rates are up. Prices are still multiple offers. Still multiple offers in Los Angeles. Is the way it is. But today was a great day. Let me just show you what happened. We got the jobless claims today. It showed that things are cooling off a little bit. Initial claims were 251,000. The market was predicting 240,000. Stock market reacted pretty good to that. Let's take a look. You guys know I love the stock market, right? I tell you every time. This is my crystal ball. And by the way, just so you know, here's a little something for you. Since June of a month ago, 1 month ago, Dow Jones closed at 29,888.78. Today, it closed at 32,000. 31 last 32,036. We broke 32,000 a day. That's 2,000 points in the Dow in 1 month. Okay, now countries going into recession and all this bad news. The market doesn't react like this. Okay, you can see that the only concern, it's not really much of a concern. I'm not a trader, but I could be one. Down here on the volume's a little light and still good enough. Okay, look, we crossed. Remember last week I told you we crossed this 50-day moving average. Remember I said that last week on the video 9 days ago. This red line's a 50-day moving average. You cross that line, look out, look out. This market can take off from here. Okay. Now, why is that a big deal? I know we're talking about real estate. Why bring up the stock market, Doug? Because this is the one that this just brings the real estate market along with it. Okay. The real estate market is a little bit of a lagging indicator. Stock market is not a lagging indicator. It is reality. It's real time. Earnings drive stock prices. Sales drive earnings. Okay. If there's no sales, there's no earnings. There's no earnings. There's no bubble up in stock prices. Okay. Look, we got cratered. Look, if you just follow the chart here, you go to this year, like, we just got beat up in June. Look at this. We just got devastated. Look at this right here back in, let's see, that's June 9th, cratered. June 10th, cratered. June 14th, cratered. And then now we're bouncing back. We're building support. Oh, over dramatization, just like always, just like this whole thing with interest rates, just speculators. Look, you see 401k valuations are going to be coming up. Things are looking good. Let's look at the bond markets. Let's look at the mortgage rates. Look at this. Mortgage rates had a monster day today, up 57 basis points. That's a big day. Now we still have a lot of ground to gain from back in January. You can see the chart right here. Okay, and we've been obliterated. But check this out. If we bring it in a little bit here, look, this again back here, June was a disaster because of the inflation report. It's all energy, but no one wants to listen to me. But it's all energy. The CPI in July wasn't the greatest either. Well, how come we didn't see any effect? Well, we should have seen market share created in July. It didn't. It didn't. It was all been overblown BS. Federal Reserve's going to meet on Tuesday and Wednesday. They're going to grab each other's ass and they're going to decide to go with about a 75 basis point increase. Okay, fine, big deal. The market's already priced. That's already been priced in. Think the stock market cares? Do you think the stock market doesn't already know that? It's already priced in there. This is looking down. I'm excited because these price changes today. This is looking down the road a little bit. Say, hey, we're going to get things are looking good. The economy's coming back. People are, the inflation's going to be under control. Who knows what's going to happen in the midterm elections? I have my own theories, but let's just see what happens. But I think whatever happens, we're going to see a much stronger stock market and mortgage market between now and December. I say mortgage rates will kind of stay about the same. They're stabilized. They're not going to go up anymore. People talk about 7, 10% mortgage rates. Absolutely not. Absolutely not. Not going to happen. It won't happen. Okay. Not going to see 10%. I don't think you're going to see 7. I don't think you're going to see 6 again. I think what you're going to see right now, we're in the 5.5, 5.7, which is too high. But bottom line, it's that I think that ship sailed. Okay, that's my opinion. Okay, but look, I base it on charts, data, volume, and statistical analysis. Okay, it's a momentum. I'm a momentum guy, and I mean momentum. I like to move. Okay, I like to move in one direction. And I'm telling you right now, the direction we're moving in is a very positive direction. If you talk to me back in November of last year, it's looking a little, it's under pressure here, and boom, cratered. Right now, I'm saying, hey, we're gonna come up out of this. We're going to build a nice little cup and handle pattern, and we're going to go higher in the Dow, which is going to bring a real estate market right along with it. Now, look, we got a lot of, like I said, you got these guys, these gentlemen and ladies that are negative, Nellies talking about the market. I'm talking. Keep in mind, I'm talking more regional, like in Los Angeles area. That's where I work, and most of you guys, all of us, look in LA. But if we go over to like Zillow, like I saw the Zillow for July, they revised their estimates down. Okay, it says Zillow forecasts 7.8 home value growth over the next 12 months. You know what? 7.8 isn't that bad. You buy $1 million house today and it's worth $1,080,000 next year. It's not bad. It's 80 grand increase in value. Okay, the house will double in value in 8.5 years, 8 3/4 of years. It's 7.8. It's not bad. Okay. Now they're talking about the sharp slowdown home value from the current growth pace of 19.8. I don't know where that 19.8 comes from. I'm not drinking that Kool-Aid, but 7.8 is not bad. No one's talking about anything decreasing. Even Zillow, and they're revising their numbers downwards. Okay, now remember, Zillow's a publicly traded company. They got regulators all over them. They're going to be ultra conservative. Okay, so if Zillow's saying 7.8, the real number is probably more like about 10.8. Okay, it's probably like a 300 basis point buffer in there. Okay, so you got Zillow forecasting. You got Redfin. Like here, this is a median sales price in Los Angeles County. Um, Sorry, guys, somehow my page got refreshed here. Anyway, here's the LA market region here. Median sales price in LA County, Metro LA. So the median price here is 881 year over year increase, 6% increase. Now, I'll give you a math lesson real quick. The median is the middle price. Okay, that means if you had a number, if you had 100, uh, 50, 30, and 20. The median price is 50. There's two below it and two above it. Okay, it's not the average. The average would be 50 plus the 20 plus the 30 is 100 plus the 200 is 300 divided by 5 is 75. Okay, so that would be the mean or the average. This is the median, the middle point, the middle where there's 200 or X number of houses, same number of houses higher price and same number of prices lower price. Median. It's high, okay, in LA County. And this counts all of LA County, all right? Now, bottom line is 6% increase year over year. Okay, a little sluggish, but in certain areas like the east side of LA, you're seeing much different numbers. Okay, you're seeing stuff probably more like 12%, 10%. You guys know better than me. But bottom line is, you're not seeing any negative. You got maybe a little bit more inventory on the market, stuff sitting a little longer. But bottom line is, you've what you not also factoring here is how about the price of rent? Rent's going nuts. Now I own a lot of rental properties, as you know. Rents it's obscene how much rental income we get. I tell my tenants, let's get you pre-qualified for a loan. Don't pay me rent. Let some other guy pay the rent. Let's get you pre-approved for a loan. Go buy you a duplex or triplex, something like that. So bottom line is this, guys, is things are getting better. There's just you have to break the data down into what applies to you. And like this year, like this I had to drill this down to get to this data here. This is just LA. Now, like you go over here to say here's a macro number. You go over here to like Redfin. This is realtor.com. You go to realtor.com and look at the data summary. You're like, okay, active listings up 29% year over year. Okay, you know that's everything. That's all of the U.S. In our market, and again, I'm talking about our East Side L.A. Los Angeles County conundrum, that area there, it's different. I'm not saying it's a bubble. I'm saying it is a little bit insulated, and you can't compare that to a macro number that's going to encompass everything in the continental United States. So bottom line is, digest the data and look into it and drill down and see what applies to you. Now, if you have questions, I want you to reach out. Okay, reach out. The next update's gonna be in Tuesday, Wednesday, after the Fed meets, most likely. Let's see how it goes. I'm sure they're going to raise the three quarters. It's already baked into the pricing. The only thing that can change it, is if they raise it like a 1 full percent, or maybe they'll do a 0.5%. I don't think so. I think they're kind of stuck with the 0.75%. The Fed's credibility is kind of not there, so I think they have to try to build some sort of credibility and kind of go with what the market predicts. So I predict like 0.75 point increase. Again, it's to the federal funds rate. It's not to mortgage rates. It's not. It's just going to affect credit cards, student loans. It will affect your home equity line of credit if you have a HELOC. So maybe if you have HELOC and you need cash, maybe look at doing a cash out refinance, consolidating some debt, or using it to build an ADU. Get creative, guys. There's any loan that have done this year, I know we're going to refinance them all in the next 12 to 18 months or less. Things are starting to improve. We're through the worst of it. We'll talk to you again next week. Guys, have questions, reach out. Hit the like button. Subscribe to the channel so you don't miss anything. Okay, and get these out. But every once in a while, you might miss an email, might go spam. Hit the like button to ensure you get it. Okay, guys, have a great evening. Talk to you soon. Cheers.